Okay, guys. Hello. Thank you for joining today. And I'll just give me a quick couple minutes here. They've just sent me the Zoom link so I can get in there and just kind of take a look at everything, get some things updated. We'll start here in probably a minute or two. All right, so we got people on Zoom. All right. This is wonderful. All right. Okay. Now we'll see if I can be the host to. Just a moment here, gang. I'm gonna have Amanda make me the host, and then we'll go ahead and get started. All right, let's try this again. All right, hold on one quick sec, gang. I'm gonna go see if I can grab Amanda. Be able to see, obviously, what we're doing. I'm like,
All right.
There we go.
Clip.
Yes.
Make host. Yes.
All right. Thank you much.
You are the host, sir.
Appreciate it.
Now it's showing the Zoom screen on your TV.
All right. Let's see the host. All right. Thank you much. Appreciate it. All right. Thank you much. 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 All
And I'm pretty sure everybody can hear me. Hi, guys.
Okay. All right, everybody. Sorry for the delay. Technical difficulty has been approved here and fixed, so I am back up and live. So, good afternoon, everybody. Thanks again for joining once again. I'm Cliff Cox with Cross Country Mortgage. I got a really good class that I wanted to go over with you guys today about just kind of like what's going on in the market, where interest rates may be. I've got a great video that I'm going to start with to show you with our company that we have partnered with. It's called MBS Highway. That just gives out amazing, updates, weekly to us. This is kind of how we get our inside scoop on what the market's going to possibly do, what things are going to be changing, and all of those kinds of things. So I just wanted to make sure and give you all those details and kind of go from there. So let me go ahead and get that started here. I can share my screen now, I think. All right, let's see. Yep, I got something going. Let me see if I got the right. Let's see which one I want to show here. Let's close all the stuff I don't need. Close that and okay, here we go. All right, everybody can see my screen now, I think, right? On Zoom, everybody can hopefully see that. Okay, we're gonna do today's morning update. This one's actually pretty cool. This was actually the one from August 16th, but I chose this one just to kind of for you guys to kind of listen in and see because I knew it was kind of hitting on the NAR changes and what we need to do, those kinds of things, and we're setting up a bunch of different things now that's gonna really help you guys even transition through that time as well. So hold on one sec. Let me start this. All right. Let's do it. Okay. Here. There we go.
Let's discuss what it we really have to turn and face these strange changes right now.
Okay. Everybody on Zoom, can you hear and see? Just someone unmute real quick and just say you can see or hear. Just want to make sure you guys got it. Hopefully you can hear.
We can't hear that well, but we can see the video.
Okay. Let me see.
First, let's take a look. Mortgage bonds.
This is a little better.
Okay.
Bouncing exactly off that Fibonacci level that we were counting on. So it's really
Is it better if I have it at this way instead of the full screen?
So we're starting off okay.
Yeah, it doesn't matter. I can see them well and hear pretty good.
Realtors will be now looking at a new way of doing business, and that is the collaborative compensation agreement days are over. It has been that way forever, but there's some strategies that you need to think about. We went really in depth on this on the webinar that we did on August the 14th. We had Tim Green as a guest. I think that you really should watch it and pay close attention. People are raving about how much it appears to be helping them with strategic moves that they need to make. But we went over in depth listing agent strategies, buyer's agent strategies. Remember, before heading into this weekend, about 80% of realtors are buyer's agents, and we had kind of been trained to that's who we want to go after. The listing agents will have a lot more control and power. We have to take a look at that. Buyer's agents, more than ever, if they're truly your friends, your partners, your referral sources, you really have to help them. And we go into how you need to do that with some really good buyer agent strategies to help you get through this. Remember, for the most part, buyer's agents have never had to negotiate. It's always been the easy button. It's always been, hey, don't worry about paying me, the seller pays that. But that's changed now. So they're going to have to figure out a way to get an agreement signed that shows that they need to get paid. Now, a lot of them are going to get religion now on, And how am I going to justify 2.5 or 3% when the buyer just thinks that they're going to be showing them property? So there's lots that you can help them with to endorse them, to show what the realtor does that can be extraordinarily valuable, but also help the realtor get through this period. And we go through that in detail. It's under Barry's Insights on the site. So I want you to make sure that you pay close attention and you watch this really important.
I'm going to watch that one coming up here soon too. It should be has some good information for you guys too, to kind of go over that. It's awesome. I'm looking forward to that one.
Your realtors, give them one of the many scripts that we talked about, and that is, just think about this. If there's 5 or 6% in the transaction, and that was typically always paid by the seller. Well, if you're paying half of it as the buyer now, and then when you become the seller at some point in the future, you're paying the other half, it's still kind of the same. During the transaction, you're still assuming all the burden, except instead of paying all of it as the seller, you're paying half of it as the buyer. It can almost be an advantage, because when you pay it as a seller, you're paying it on the assumed appreciated value, which your costs are greater. But if you're paying half of it as the buyer, then it kind of makes sense that you're paying half of that fee at a reduced level and the other half at a more expensive level. So you're actually potentially saving money with this change, even though you have to pay some as the buyer. There's a lot more intricacies. We go over it, but it's just one example of ways to help that real estate agent, your partner, your buyer's agent partner. And speaking of real estate agents and the activity coming to the market, Dan, we did see numbers come out on new construction side that were a little bit softer today.
We did. We saw completions, starts, and permits, and across the board, we saw declines. Let's take a look at some of the numbers together. Completions are now at 1.53 million. That's units that are being completed coming to market, and that has fallen about 10% from the previous report. But if you look at what's behind that, housing starts, that's construction that's just starting now and breaking ground, that's fallen to 1.24 million. So that's a decline, but even worse on the single family front, which is what we care about most. That's now only at an annualized pace of 850,000 units, and that's down 14% from the previous report. And then behind that, you have.
By the way, Dan, may I also add, it's down, like, let's call it 15% year over year.
Yes, and the overall number of starts is the lowest level since like 2019, and the single family the lowest since like April of 2023. So we're seeing less supply starting right now, and then behind that you have your permits, which that's at 1.4 million. That's down, and not all those permits are actually going to come to fruition and be started. You're seeing a greater amount of fallout than usual. So I think the bottom line here, team, is that supply is going to be tight for the foreseeable future. It's kind of a double-edged sword, because while it doesn't help us on the inventory and transaction side of things, it is supportive of home prices.
And Dan, speaking of new construction, we actually heard from the NAHB regarding home builder sentiment. So I'm just going to pull up my screen here. We'll take a look at the numbers together. So the overall index was weaker. It went from 41 to 39 this month. Current sales was also weaker and buyer traffic was also weaker. But the one bright spot here was in sales expectations. That rose once again this month from 48 to 49. And this echoes some of our thoughts that over the next 6 months, we're going to see rates decline, and in turn, buyer activity will pick up. Now, for next week, we'll get some more housing data in, but it really will be all about the Fed. On Wednesday, we're going to get their Fed minutes from the latest meeting, but it also represents the start of the Jackson Hole Symposium.
Well, thanks, team. All right, let's take a quick look at the charts here. And as I mentioned, we're getting a very nice little bounce. So we'll start with mortgage bonds, which are up 9 basis points. You can see it here. So this nice little bounce higher, and you can see how this level had held yesterday. We said we hope that we hold off of this level because we had the previous week, and sure enough, we did. We're seeing it move up. Now we're in a wide range here, so we could get whipsawed. But as you can see, there's more ground to gain to the upside than there is to the downside. And as we look at the 10-year Treasury, well, the 10-year Treasury did test that ceiling yesterday, that Fibonacci level. Remember, we were above it. We said, let's see if it gets back under, and sure enough, we did, closing right at the Fibonacci level. We opened there this morning. We're a little bit lower, and take a look here. If this is going to be a good, strong ceiling for us, well, there's a lot of room to the downside where things can improve. We'll probably have an interim level of support here at about 381, but underneath that, there could be some nice gains. And as Jake said, next week is all about the Fed and Jackson Hole. So dependent on what they say, is where we'll go here. But we're going to end the week floating.
Okay. So those are the kind of videos that we get on like a daily, basis, guys, just to kind of have an idea of what's going on and these kinds of updates and what's changing things. And so we're starting to get more, some more positive information in that that we're hearing what's going on with the market and what factors are the ones that change it. And so this one I actually just saw. I'm going to pull up um my PDF, I think, here first, just to kind of go over. I know this isn't the funnest thing to kind of look at, but I mean, it just has such good information. I pulled this right off of Freddie Mac's website. Freddie Mac, for those who don't know, is one of the conventional marketing partners that are out there that helps, they write and help specify conditions on conventional loans. So you have Fannie Mae, then you have Freddie Mac. Both of those are the ones that we look to for what's going on, what are the changes going to be, and those types of things. And so a couple of things I just wanted to kind of go over with some of the recent developments, as you guys can see here. I'm just going to read through, some of this stuff. So despite mortgage rates being almost 50 basis points lower than they were at the beginning of May, housing demand remains weak as reflected in lower, home sales. And so it is part of kind of like what's going on. Home buyers continue to pause to wait for decline even further. Because you got your group of buyers that are out there now. They're like, oh no, we're just going to wait until rates come down. And I mean, and that's not necessarily the case that what it should be. I mean, educating them now and letting them know, I'm like, look, they know that rates are going to go down, so we need to help them with that mindset and teaching them to show, hey, if there's a house that you love and you want to put an offer in and you could see your family growing in that house, it's get that house now, because then 6 months from now, 8 months from now, or what have you, you can get into a refinance and lower your payment and getting their family into that potential financial situation just better off. So just things like that. I just love looking at these things because it helps me help my buyers understand where I need to help educate them to be and not be scared and not be tentative on pulling the trigger. There's been sellers that have been, holding off on selling because they're not sure either where they're going to go or what their situation is going to be. It's all about education and letting them know, like, look, these are the numbers, these are the facts. We know that rates are going to be getting better. All right. So, and as far as recent developments, the U.S. economy, the first estimate of Q2, which is the second quarter, U.S. economic growth released by the Bureau of Economic Analysis, was the BEA, just showed July GPD, which is gross demand profit, grew at an annualized rate of 2.8%, up from 1.4%. So what that means is that the growth was led by consumption, spending, private inventory, building, non-residential investments, those kinds of things. That means people still going out and spending money, people, having vacations, updating things, those kinds of things, just fixing up their property, spending money into the economy and keep getting it to turn. So, and then let me see the other highlight on here. Yes, one possible explanation for these increases in inventories could be that retailers are increasing inventory for holiday orders much earlier, to ensure against the future shipping disruptions that have occurred since the pandemic. So it's not just all about inventory, guys, and homes to sell. The economy is look at it like a big mixing bowl. And there's so many different components that go into that mixing bowl that can, elevate or decrease or just change overall what the economic market is going to look like. Because you have not just inventory, you have, inflation, you have the jobs report, you have, the cost of goods, all those types of things get put into this bowl. And we try to figure out, okay, how do we navigate this? When do we know that things are going to change? How do we prepare and, get people set up for when things do increase? This affects what the minimum wage is for people, all those kinds of things that can, affect and change what's going on, and that can, change interest rates from basically our perspective in regards to, residential transactions that you guys handle. All right. And so I'm going to scroll down to, here we go. Let's just get into the jobs. So, all right. So job openings moderately, slightly in June, up to 8.18 million, from 8.2 million in May, remaining at the lowest level since March of 2021. The job openings to unemployed ratio for June was 1.2, and that's been the lowest level since 2021 as well, closer to 2019 average. The quit rate was 2.1% for June for the number of quits at the lowest level since November 2020. The number of hires at 5.3 million was the lowest since April 2017. The hire rate is at its lowest level since February 2014, if we ignore the pandemic recession. What's important about this is, as I mentioned, that's one of the components that affects and can change what interest rates are, is the job market. That's one of the big things that help, that does play a role in what the market's going to do in regards to interest rates and what the Fed's going to do and all of that. And then inflation has been moderating towards the Fed target. The Federal Reserve's preferred inflation gauge, the core personal consumption expenditure price index, which strips out the volatile food, energies, prices, all those kinds of things, plays into effect. Now, what I'm going to do is pull up today. This is a little more easier to kind of go through. I know those are numbers and terms and things like that. It's a little bit different, but I wanted to kind of pull this up today to kind of really shows what affects things and what the U.S. Treasury, has its impact on what we're doing as well. So Treasury yields rise as trade await for, Powell's remarks. And what, Powell is it's the Federal Reserve Chairman, Jerome Powell. Everything kind of weighs and goes off of what, he says at these meetings. They deliberate, during the week, all of the different types of people that are involved in regards to making decisions on what they, where the inflation rate is it acceptable for the U.S. economy, all those kinds of things. And then they come out and decide, hey, this is where we need rates and stuff to be. So on Thursday, investors looked ahead for the remarks for the Federal Reserve Chairman, Jerome Powell. The yield on the 10-year Treasury climbed more than 6 basis points at 3.839, while the yield of the 2-year Treasury added almost 6 basis points to 3.98. So the yield prices move in the opposite direction. 1 basis point equals 0.01. So as you can kind of see, this is how it factors in what the U.S. Treasury does, and all those kinds of things is what I think what things change and when they change. Now, this is the part that kind of gets good as we get into this. So Powell is set to give a speech to the annual Jackson Hole Symposium on Friday. His comments after the release minutes of the central bank's July police meeting. The minutes show that the vast majority of Fed officials observed that if the data continued to come about as expected, it will likely be appropriate to ease policy for the next meeting. So what that means is market participants are firmly pricing in an interest rate cut in the U.S. central bank's next meeting. So traders are currently pricing in roughly 66% of a 25 basis point cut reduction in September, with just over a third pricing in 50 basis point price cut, according to the CME Group's Fed Watch tool that we have. So jobless claims data released Thursday came in slightly higher than expected by economists, pulled by Dow Jones. That can add to a growing view that the labor market is not as strong as once believed, a theory bolstered in Wednesday when non-farm payroll growth went down by 818,000. So all that mumbo jumbo garbage that I just kind of spoke to you about was basically saying that we're looking to see a rate reduction coming up here, at least another one in September. So right now the trend is showing rates, when they were up in the 7 and 8% range, just a few months back, we're already now back into the 6s. So now what does this mean for people that are, have either purchased a property in the last 2 years or the last year or so when rates were in the mid 7s, 8s or whatnot? They'll be looking to refinance, which will help, get the economy going again. Plus now you have your hesitant sellers that have been on the market sitting and waiting for rates to go down. Now that rates are going to be going down, they know that hey, if there's something they need to buy, even if the pricing market is as strong as it is right now, because you're not really seeing all of the reduce in values, for homes that are, where people I thought they were maybe anticipating. When you have, when you're in any kind of, depression, or something like that, you have when the economy is, quote unquote, depression, all those kinds of things, that means everything starts to go down. That means the cost of goods start to go down. That means the cost of real estate, whatever have you, you get that reduction. But that's really not, changing as much as people thought. But the economy is still getting stronger. It is starting to ease up a little bit more. And at least from what the Fed is telling us, they are planning on reducing at least maybe 2 more rate cuts now this year. So there should be one in September and then one further down the year. So that's going to help buyers, and it's going to help sellers too be able to get another mortgage to qualify, for what they're wanting to do. So those kinds of things, the blend between refinances for people that just bought homes and they're trying to get their payments lower, plus now inventory hopefully getting better when sellers want to sell, and people wanting to buy their properties as well. So it should kind of even out. Everything's always been cyclical. As long as I've been in this business, I've seen it kind of go up and down with all the different changes and regulations and policies and all those kinds of things. And so I know you don't need to be experts at this and what's going on with the market, but it's nice to have like a basic general knowledge of what are the indicators that do affect your business and how you could, explain or just have a general understanding how to deal with it. So certain factors that are just out of our control that affect rates, with the economy and what, things do. So I just wanted to make sure and get you this much information just to kind of hear where we're seeing as a company, where we're expecting, like we're already seeing rates, like I mentioned, already down in the 6% range, which is great. So right now we're in the round like 6.5, 6.875, those types of rates right now. So which is a great sign. Honestly, I didn't think we were going to get below 7 at all this year, and we're already starting to do that. So it's definitely a good thing. As far as different types of programs and things like that we're going to try to help roll out here to help you guys. I know we already have our CCM Smart Start program, that because I have a client that just got approved for one today. It helps with up to 2%, up to like $5,200 towards their closing costs. So, and those kinds of things for you guys, the buyer's agents, that 2% is going to be the ones that can qualify for conventional first time home buyer, 3 to 5% down, are going to be able to get that 2% towards their cost. So that's going to help with monies that maybe a buyer's agent may have to, maybe have to get paid through the buyer and things like that. So we're we're revamping and looking at all of our down payment assistance programs, anything that we can do to kind of help you guys. And help first-time home buyers, really, because they're the ones that really need the money, just to be able to, have that dream of home ownership. So as a partner of, with you guys, this has been our main focus since we knew all these kinds of things were going to happen. And so everything that gets rolled out, we'll let you guys know. I know there's a couple things that I'm going to touch on. I think that at the next team meeting, when we have the opportunity to, kind of chat and speak and go over some things, there's a couple things I know that cross country is working on that should be getting rolled out, I think, as early as next month. So they didn't give us everything yet. They just said it was coming, and we're gonna let you guys know what that is. But I think it definitely is going to help sellers out as well as buyers. So lots of good information on that. Any questions at all? I know this was a lot that I kind of threw at you just in with the next half hour, but I wanted to check and see, does anybody have any questions or concerns about what's going on in the market, what your guys are seeing or what you're hearing, anything of that nature? Yeah. Yeah. That's at least what we're being told. I know. It's the magic question. It's good to know. Yeah. And this is all stuff you guys can get by just getting on, CNBC and just looking at what, the U.S. Treasury, and kind of just focus on that. You put that in a U.S. Treasury mortgage rates. It's a good indicator of what they're going to possibly do. And it lets you know when the next Fed meetings are and what they're going to be discussing, because normally, if they know what the outcome is going to be, you will even start to see investors, adjust rates even before the meeting. Because sometimes information gets out and they're like, hey, look, this is what the Fed is leaning towards. Investors may automatically be like, hey, let's adjust rates up a little bit if we think it's going to be a bad report, or we're going to go ahead and lower them because we know what's coming. We're going to try to get people to, lock interest rates now and get into mortgages because we know they can be saleable on the open market, those kinds of things. Because when it comes to interest rates and mortgage loans, I mean, there's no real one company that works off their own capital. Like my company, Cross Country Mortgage, there's banks, there's other mortgage companies out there. Everybody has, they write mortgages and then they sell them off to either Fannie or Freddie, which is the conventional partners, or if it's FHA, those kinds of things. Those partners, those secondary marketing partners, are the ones that come in to free up the lines of credit for banks, like in mortgage companies like myself, to allow them to keep writing mortgages. And so that's just kind of like what they do. Now, when you have a change in servicing, like say, for instance, you closed on your loan and your servicing got sold to, Bank of America, or if it said it got sold like with us, like Mr. Cooper. Mr. Cooper is a servicing company for us. It's not necessarily a bank. They're just the ones that handle the mortgage payments. Your mortgage could still say it's still with Cross Country. It just depends on who's the servicing rights is going to be. So those kinds of things. But yeah, everybody gets, some banks, and we do have our own portfolio of products that we write off of, and we use our mortgage, our funds for those types of things. But in general, conventional FHA, VA, all those kinds of things, all those mortgages get bought up and, get sold out to the open market. So like when you have a client that has, say a 740 credit score, maybe they put 10% down or 20% down. And, because that's why it's so important educating clients on a credit score, because it shows their ability to repay. So when you've got clients like that, those types of mortgages are less risk to go into default, and so they make it more popular and more attractive for the secondary market and these investors out there to buy up these pools of mortgages. It's basically called, that process is called securitization. And so depending upon what the interest rates are, then depending upon what the quality of the buyer is, that's why when you have a period of time where interest rates are a little bit higher, you'll get some investors that will buy into these, but then some won't, because they know they're going to refinance here in like less than a year. So a lot of these mortgages have been kind of, just kind of been sitting with the secondary marketing partners and not being bought up by investors until rates start to lower a little bit, and then they stabilize. Then they really jump in there and try to, do what they got to do to buy up some of these mortgage, backed securities, and because they know that they'll bring yield and money over time. So in a nutshell, that's kind of how interest rates work and the effect of what a buyer and might have. But I wanted to make sure and at least get you this information, guys, into what interest rates are going to be. So stay positive, educate your clients as much as you possibly can. It is definitely getting better. We're getting this information from the Fed. So this is not just us putting our 2 cents in. This is all backed information that we get on a daily basis, either through MBS Highway, which is our main channel of information for how the market's doing, and then just going right to the basic outlets that every person in America can go and actually in the world can go and check in and take out. So lots of good stuff. Okay. So any questions for anybody? I'm gonna stop share here real quick and just get back here to make sure there's nothing in the chat that I don't see. Okay, looks like everybody's good on there. All right, any questions or anything you guys want to touch on, any scenarios, anything that I can help you with? Everybody seem good? Okay, all right, so stay alert with us, guys, and anytime information, I'll definitely get it out to you. If you guys have any questions, market updates, things like that, definitely give me a call. If you've got buyers or you got sellers on the fence, have them call me. I'll kind of talk them through maybe what's kind of going on, what maybe to expect, how we can kind of show solutions for them, whether it would be with getting the interest rate a little bit lower, or maybe using some of those proceeds to pay something up, all those kinds of things to help their overall financial situation. This is why we're here, and this is why I want to help you guys in any way that I can. Okay, so thanks again for joining today, and like I said, you need anything, please feel free to reach out. You guys
Thank
enjoy your day.